What is up, guys? Welcome back to another video, and today we are going to look at 5 tips that are going to make you a better investor, and it starts right now. What is up, guys? Welcome back to another video. Again, my name is Matt, and in this portfolio, all we do is invest $20 a week and we watch it grow. So today we are going to look at 5 tips that are going to make you a better investor, and it starts right now with number 1 being avoid the dividend yield trap.
It's a trap!
So what do I mean by this? Well, if you're like me, or if you were like me, all I did was I got online and I just started looking up the best paying or the highest dividend yield that stocks would produce, and it would just shoot out these stocks that no one had heard of. So I'm actually going to go to one in Seeking Alpha that shows just this. So here we are looking at Great Elm Capital Corporation. So this is a stock that is $3.72, and you can see that roughly about, looks like January it was at $7.83. Obviously the pandemic hit and it has since tanked. So over the last 6 months, it has made a little bit of a comeback to $5.31 before tanking yet again. So this is a stock right here that, old me would have looked at it and been like, oh my goodness, look, it pays a 26.77% dividend yield. Why not put $100 in it? Because each and every month I'm going to get 8 cents return on it. Well, if you also look at its payout ratio of 166.67%, that means for every $1 that comes in, they're paying out $1.66.67. So this is something that cannot go on too much longer before either the dividend gets cut or gets rid of altogether, because the company is just bleeding money at this point. So this is something that you just have to look at when you're looking at stocks. I think dividends.com will shoot out a bunch of stocks that just goes in order of yield, and you just got to look at it.
Would you look at this? You know what I mean?
You compare companies like AT&T. If we look at AT&T, you see it sits at $29.09, and this is a stock that's going to trade between $29 to $31. Now, with that being said, the dividends itself will pay a 7.19% dividend yield, and the payout ratio is 65.06%. So this is a company that is a billion-dollar company, and it's got 25 years of growth with its dividend because its payout ratio is only 65%. So that means there's 35% that the company's able to reinvest into the company, pick up more, things like DirecTV. Now, I know that didn't work out too well, but it gives it a chance to grow. So this is a company that's grown over 25 years, and you can see the dividend growth, $2.04, $2, $1.96, $1.92, so it's growing a penny per quarter, 4 pennies, 4 cents a year per stock. So this is something that's going to continue that because of its payout ratio. On the other side, companies like Altria, ticker symbol MO. This is a stock that's at $43.48. Look at it. January, it was at $50, 5-year trend. Look at that. We do not want to see it declining in that 10-year trend. Kind of the same thing, going up and down. If it's going to stay sideways, that's fine. But this is a company that it's got a 7.94%. Now the years of growth it's at 17 years, and it looks on paper like it pays a pretty good dividend, and the dividend growth is up there. But again, that payout ratio is creeping up there at 79.75%. I myself would not invest in Altria, but you do you. The second step to becoming a better investor is going to be age determines aggression. So again, what do I mean by this? That means the younger you are, the more aggressive you should be. In your 20s, even early 30s, I think you should be as aggressive as possible, because you have what I don't have on my side, and that is time. I am 35 myself. I am still probably, I shouldn't be as aggressive as some of these, 20-year-olds and even early 30-year-olds, but I do have 27 years before essentially, if I'm retiring at 62. So I could be a little bit more aggressive. I choose not to be just because I want to be as conservative as possible, but not too conservative. I think on the other side, the older you are, the less aggressive you should be. If you're in your 40s, in your 50s, and retirement is right around the corner, you probably shouldn't be investing in a lot of speculative stocks and stocks that could move the needle one way or another, more negative than anything, because you don't want to have that much risk. So again, age determines your aggression. Number 3, consistency. So this means that you need to stay consistent with your investing, whether that's weekly, monthly, bi-monthly, so on and so forth. I think by having money set aside, you don't have to invest it right away, but by having money set aside, when we have times where the market dips a little bit like this, you can pick up some deals just by staying consistent. I mean, we saw when the market tanked a little bit, we saw pretty big rebound. And if you had money sitting on the sidelines or you were consistently investing, you were able to see the repercussions or the ramifications of that investment. So just having that money on the side, being consistent in all you do, that's going to make you better overall. Number 4, talk with other investors, whether that's on Instagram, whether that's your buddies, whether that's, some guy that you work with. Just talking with stocks and investing with other people is just going to make you that much better. I have a buddy of mine, he's got like 150 grand in the market. He's solely in Nike, Apple, Tesla, and him and I got to talking, and I started bringing up companies like or Realty Income or Stag Industrial, and he had never heard of them. And I'm sitting here going, dude, you've been investing in the market for 15 years and you hadn't heard of them yet? And I've been in the market for 5-6 months, and these were 2 companies that popped up right away. And I had to go in and explain to him about Stag Industrial and how it's a warehouse and how they're partnered up with Amazon and they're on these long leases, and Amazon's not going anywhere anytime soon. Why wouldn't you put money into this? And on the opposite side, he's sitting there telling me about how my portfolio is it's too conservative and I need to have a couple speculative stocks in my portfolio. And we just kind of go back and forth. So I think being open to others is definitely going to help you in the long run, and it's going to help you rethink how you look at your portfolio. Number 5, don't invest money that you cannot lose. So if you are investing your rent, if you're investing money that is really going to negatively affect you, do not do it. It's like going to a casino, and if you bring $200-$300, if you cannot afford to lose that money, you should not be doing it. So make sure that again, if this is money that if the stock market or that particular stock or stocks went down to 0, would you be okay? I understand, in my situation, I'm sitting here with a portfolio of over or close to $1,300. If I lost this today, it's not going to affect me one bit. This is money that's set aside. I can afford to lose it. I'd be pissed off, yeah, but it's not going to affect me long term. So you have to be able to separate your emotions from it all. So guys, that's going to do it for today. Again, those are the 5 tips. Avoid the dividend yield trap. Age is going to determine aggression. Staying consistent in all of your deposits and just consistently investing. Number 4, talking with other investors. And number 5, don't invest money you cannot afford to lose. Thank you for watching. If you liked the video, smash that like button, subscribe. Let me know down in the comments some other tips that you may have, because I think maybe revisiting this 3, 6, 9 months from now, we can make a better video and just go from there. So thanks again. Happy Friday to you. Take care. Have a great weekend, and we'll see you guys next week. Thanks.